Hi, I'm Bob Powell with FinStream, and welcome to our explainer on the GENIUS Act, the Guiding and Establishing National Innovation for U.S. Stablecoins Act. This landmark legislation, enacted by the 119th Congress, establishes a comprehensive framework for regulating payment stablecoins in the U.S. So, what does this mean? First, some key definitions. A digital asset is a digital value on a cryptographically secured distributed ledger. A payment stablecoin is a digital asset for payment or settlement whose issuer must convert it for a fixed monetary value maintaining stability. It does not include national currency, deposits, or most securities. A permitted payment stablecoin issuer is a U.S. formed entity, a subsidiary of an insured depository institution, or a federal or state qualified issuer. Under the GENIUS Act, only permitted payment stablecoin issuers can lawfully issue stablecoins in the U.S. Digital asset service providers are also prohibited from offering non-permitted stablecoins to U.S. persons after 3 years. Foreign issuers must comply with U.S. orders and reciprocal arrangements. Limited safe harbors exist for minor transactions or exigent circumstances. Violations are severe. Unlawful issuance can lead to fines of up to $1 million, up to 5 years imprisonment, or both. Non-permitted stablecoins won't be treated as cash or collateral by financial institutions. The Act does not apply to direct transfers between two individuals or transactions via self-custody wallets. Permitted payment stablecoin issuers face stringent requirements. Maintain one-to-one reserves. All outstanding stablecoins must be backed at least 1-to-1. Reserves include U.S. coins, Federal Reserve funds, demand deposits, short-term Treasury bills, and certain government money market funds. Prohibition on rehypothecation. Reserves generally cannot be pledged or reused by the issuer. Public disclosure and certification. Issuers must publicly disclose their redemption policy and fees. They must also publish monthly reserve composition certified by their CEO and CFO and examined by a public accounting firm. False certification carries criminal penalties. Capital, liquidity, and risk management. Regulators will issue tailored rules including Bank Secrecy Act and sanctions compliance standards. Anti-Money Laundering, AML compliance. Issuers are financial institutions under the Bank Secrecy Act, requiring effective AML programs and suspicious transaction reporting. Technological capability for lawful orders. Issuers must be able to comply with orders like seizing or freezing stablecoins. Limited activities. Issuers are generally limited to issuing, redeeming, and managing reserves. No deceptive names. Stablecoins cannot imply they are U.S. government issued or guaranteed. Prohibition on interest yield. Issuers are forbidden from paying interest or yield to stablecoin holders. Felony convictions. Individuals with certain felony convictions cannot serve as officers or directors. The GENIUS Act establishes a dual regulatory framework. Federal oversight. Federal issuers are licensed and supervised by the Comptroller of the Currency. State-level regimes. State-qualified issuers with not more than $10 billion outstanding can opt for state regulation if it's substantially similar to the federal framework. States must certify and annually recertify their regimes. If a state issuer exceeds $10 billion, they generally must transition to federal oversight. It's critical to understand that payment stablecoins are not backed by the full faith and credit of the United States, guaranteed by the U.S. government, or subject to FDIC or NCUA deposit insurance. Misrepresenting their insured status is unlawful. Regulators review applications, and issuing a stablecoin on an open, public, or decentralized network is not a valid ground for denial. Regulators have broad supervisory and enforcement authority, including imposing penalties. While state regulators hold primary authority, federal authorities can take enforcement action in unusual and exigent circumstances. In insolvency, stablecoin holders have priority for their claims against reserves. Regulators will also assess interoperability standards for compatibility within the digital finance ecosystem. Foreign stablecoin issuers may operate in the U.S. if subject to a comparable foreign regulatory regime registered with the comptroller and hold reserves in the U.S. The Treasury Secretary can establish reciprocal arrangements. This comprehensive framework aims to ensure the safety and soundness of payment stablecoins, promote financial stability, and combat illicit activities, laying the groundwork for innovation within a regulated environment.